Corporates often employ terms like early bird offer or new to the market in their advertising to entice potential investors. Do these offers pose opportunities or risk to investors? The proverb early bird catches the worm suggests that being proactive leads to success. But in the corporate world, this idea is often exploited through schemes like early bird offers. This video discusses those situations and how to scrutinize those offers before investing. Welcome to holisticinvestment.in. It is essential to recognize that while acting swiftly may seem advantageous, it can also make one vulnerable. Investor may feel they are seizing opportunities, but they might inadvertently fall into the trap set by corporates. When presented with a new initial investment plan, individuals are often drawn to it without thorough consideration. Let us understand this with some real-life historical scenarios. The Morgan Stanley Growth Fund 1994 was introduced as a closed-ended fund with a 15-year term. Initially launched by an international firm, it was perceived as a golden opportunity, drawing significant interest from investors who were eager to capitalize on it. The initial investment application process saw a staggering queue of applicants stretching up to 2 kilometers. Much like initial public offering, this fund generated anticipation and excitement upon its entry to the market. The fear of missing out and the desire not to overlook a potential lucrative opportunity drove investors to jump on board in 1994. Despite the high expectations, the net asset value (NAV) of the fund, initially set at Rs 10, debuted at Rs 8.98, resulting in an immediate loss of 10%. This was a closed-ended fund which prevented immediate selling. This led to frustration among early investors. Due to the listing day loss, the early bird story took a turn than expected. IPO frenzy. Despite the abundance of well-performing stocks already available in the market, initial public offering IPOs continue to hold considerable allure for investors. In 2008, Reliance Power made its market debut through an IPO, offering shares at Rs 450 each. The IPO garnered an impressive 11,563 crores, oversubscribed by over 70 times. Investors, fueled by various assumptions, anticipated an immediate 80% surge in the stock price on the first day. However, this excitement was short-lived as the stock stumbled to Rs 372 on the same day. Since then, the stock has failed to return to its IPO level even after 15 years. The current trading price of Reliance Power stock is around 30 rupees. This reflects a significant decline from its IPO price. This case showcases the IPO frenzy. For further insights, consider reading the article Factors to Consider Before Investing in IPOs. The link is given in the description. A magical whale called New Initiatives. Imagine a scenario. Someone in your household requires medical attention, or you are looking for a school to enroll your kid. Would you opt for a brand new one or a well-established one? It is interesting to note that we prioritize experience and reputation in areas like healthcare and education. But when it comes to investment, we often find ourselves drawn to new initiatives. The allure of the term new is undeniable. It suggests progress and fresh opportunities. Many organizations capitalize on the psychological tendency. They use the word new as a powerful marketing tool to attract investors. In essence, the concept of new scheme acts like a magical veil, concealing the potential pitfalls. The launch of a new fund offer often grabs more attention than existing mutual fund schemes due to the initial net asset value being lower, typically starting at Rs 10. This lower NAV allows investors to acquire more units, fostering the perception of greater diversification. It is important to recognize that NAV is merely a denomination. The total investment amount holds greater significance, just as having Rs 10,000 in 10 rupee notes result in 1,000 notes, while the same amount in 100 rupee notes yield only 100 notes. The value remains unchanged. Evaluating factors such as historical performance, portfolio allocation, and fund house policies is crucial. NFOs lack track record and portfolios, posing a challenge for investors to make informed decisions. It is prudent to opt for mutual funds with a proven track record of at least 3 years and conduct thorough analysis before investing. NFOs offer little additional benefit but pose higher risk. Next, investing in cryptocurrencies introduces new risks that demand caution. Many investors experienced significant losses in 2020 due to unforeseen circumstances. The highlight is there is no regulatory body like SEBI or RBI to govern cryptocurrencies. The lack of regulation increases the potential for fraudulent activities, requiring investors to navigate legal proceedings which can be costly and time consuming. The value of share correlates with the company's performance and activities. The value of Indian rupee is influenced by the country's economic growth. But the value of cryptocurrencies fluctuate without any logical reason or rationale. This uncertainty raises questions about the reliability of such investments. Despite the lack of clarity, the allure of quick profits has drawn 1.9 crores investors in India to cryptocurrencies, resulting in significant losses for many. The fascination with the unknown and the associated risk remain key factor contributing to investors' loss in this arena. Introducing new trends to persuade investors has long been a strategy employed by corporates. During the era of Harshad Mehta, the replacement cost theory emerged, manipulating stock prices and resulting in losses for investors. In the late 90s and early 2000, there was a rise in technology-related stocks. A new acronym was coined TMT, Technology, Media and Telecommunication. There was a surge in stock prices of these sectors. This trend spurred the popularity of IPOs focusing on technology stocks, but ultimately ended in losses for many investors. The market witnessed a boom in technology stock and the word technology became a buzzword. Many investors were misled by companies simply incorporating the word technology into their names to capitalize on the trend. The subsequent correction in technology stocks in the year 2000 halted the trend. Similarly, in 2020, a new trend emerged with ESG, environmental social governance stocks, emphasizing sustainability and ethical practices. Unlike past trends, ESG investing aims to avoid excessive speculation. Here is our conclusion. Accepting and welcoming the change or trend applies to other aspects of life. But when it comes to investing, a balanced approach that considering both new and old strategies is paramount. Sound investment principles rooted in fundamental and ethical policies have consistently yielded benefits for investors. Rather than blindly following trends, prioritizing informed decision making based on these principles can lead to more favorable outcomes in the market. A detailed blog post on this topic is available in our website and the link is given in the description.
Hope you like this video. If you have any questions related to this or any other investment option or related to your financial goal, don't hesitate to book a free appointment with our financial planners. The link to the free booking is given in the description box below. Also, will you be interested to attend any insightful investment webinar? Then feel free to register for the upcoming enlightening investment webinar. It is completely free. The registration link for the upcoming webinar is also given in the description box. If you like this video, please give us thumbs up. Also, share it with your social circle. If you haven't subscribed our YouTube channel so far, please subscribe now.